Okay, in today's video, we're going to talk about risk management strategies that you can apply to your Forex trading. And this lesson is in our beginner's course on our website at forexearlywarning.com. We're going to talk about 12 different ways to manage risk. Now, there's actually probably about 15 ways to manage risk. We took the top 12, put them in here. And you hear a lot of Forex traders say that trading the Forex market is risky, but if you start employing these things, you'll find out that your actual risk is very low and it can be completely controlled. So the first thing you need is a great trading system. If you're using a trading system that simply doesn't produce any pips or show you where the pips are, where to go where the pips are in the market, and you can't make any pips, your risk goes way up because you can't get any reward. So this type of trading system and much better trade entries where you have live indicators that show you where the market momentum is. This is a nice strong movement. If you only get half of this movement off of one of the pairs, the Euro Yen, the Aussie Yen also had a great move. These are great movements. Even if you just got half of this move, that's 50 pips. And most Forex traders don't see this type of movement. So if you have a trading system that doesn't ever produce any pips, then your risk goes way up because you have zero reward for all your trades. And this is the Forex Early Warning trading system right here. Learn more about it on our website. Same thing, back to the trading system, avoid technical indicators. Technical indicators are, you have a screen full of layers and layers of indicators, trading the same pairs over and over again, and you don't know where the market momentum is. So stay away from technical indicators. We have an article, if you linked right here, that talks about technical indicators, completely refutes technical indicators. You need to go with the individual currency strategies like the one you see here for the yen pairs, and it works for 8 currencies. And instead of technical indicators, we can give you a chart setup that has really no indicators. It's basically lining up all the yen pairs side by side so you can see the movements more clearly when the yen is weak and the yen pairs are all moving. And you can look at 7 charts at a time and it matches the Forex Heatmap readings. Fantastic chart setup and avoiding technical indicators. Obviously, with a great trading system, you still want a demo trade. You can see a great trade entry, but you still should demo trade to make sure you understand the trade entry process, how to scale out lots, and how to manage the profit that you'll get. So you demo trade is good risk management. Setting and moving stop orders is good risk management. You enter a trade, you scale out lots, you move your stop to break even, and you can continue to scale out lots as the trade proceeds in the direction that you traded. And if the pair is trending, you can hold on for additional pips. So trading with the trend is another risk management strategy. It's not even listed in this article, this illustrated article, but trading with the trend is another way to reduce risk. Another way to reduce risk is risk capital. Most good financial planners will tell you that you only risk 5% of your liquid assets in something like the Forex. Another way to do it is with to obtain third-party live capital, where you risk no money at all. There are firms out there, there's 30 to 40 companies that will provide you $1 million in trading capital to trade with, and they'll cover your losses for you. So, but you have to have a great trading system, and you have to have some demo trading experience to make sure that you're on the right path. And then they'll split the profits with you, some of them up to 90%, 70, 80, 90% profit split with these firms. If you want to learn more about those companies, you can click on this link right here. But there's plenty of companies out there that will provide you with trading capital so you don't have to risk any of your own. Another thing you can do to improve your risk profile or reduce risk is to stick with the higher time frames. If you go with the higher time frames, the H4 time frame or larger, and those pairs are trending, you have a better chance to make more pips. It's if you're scalping the smaller time frames that your money management ratio is upside down, and over the long term that'll cause you to crater, and your risk profile will be way too high. If you think you can make 100 pips on a trade, and you risk 30 pips on your initial stop, well, that's about 3 to 1 positive money management, and that would be like the minimum you would want to have. Your risk reward profile on an individual trade. So if you can get the risk reward profile to 4 to 1 and you're only accurate half the time on your entries, you can definitely increase your account balance pretty darn fast. And not only are you getting into a situation where there's no risk, but there's quite a bit of reward. And you can improve your money management profile and ratio on individual trades that eventually will add up to your account balance moving way up faster. Leverage is a risk management tool. You only have to put up $1 to get $50 of value. On some trading accounts, outside the USA, you can still get up to 500 to 1 leverage. So if you want to trade $500 in currency or $50 in currency, you only have to put up $1. So this means that you're working with a 2% margin amount at 50 to 1, and you can trade large amounts of currency with a smaller amount of money out of pocket. So it's a risk management tool. Position sizing is also a great way to manage risk. If you have a trending market, and let's say all of the euro pairs are trending up with the chart setup that we told you to set up, all the euro pairs side by side, all the euro pairs are trending up, your risk is lower, so you can probably trade more lots in that situation. But if all the euro pairs are choppy or going in two directions, well, then you need to move away from the euro pairs because it's too risky, it's too choppy. But maybe you can move over to the yen pairs or the US dollar pairs, and there'll be better trends to look at. So, but if you do see some charts that look choppy or risky, you can reduce the amount of lots traded on each trade. You don't have to trade the same number of lots on every trade, and that'll be great for your risk profile. And also, experience and knowledge is the best teacher. Obviously, someone who's been trading the Forex for about a year is going to be in much better shape than someone that's, just started last week. You can go to our website. You can learn about Forex trading at no cost. It's a great trading system. We've got a great indicator system, great charting system, and you can learn about it, this type of system on our website. And then you can compare that to other trading systems, and then you can start to make comparisons, figure out what the best way is for you to trade the Forex market. So there's a long list of things that Forex traders can do to eliminate risk. Remember, if you're demo trading, there's no risk. The only risk you have as a Forex trader is when you enter a live trade and your only risk amount is the amount to your initial stop. After you move your stop to break even, there's no risk. So you do have a period of time where there's risk, but it's completely managed and controlled. So this is 12 different ways to manage risk. There's probably more ways that aren't even in this article. And this is in our beginner's course on the forexearlywarning.com website.